All right. Yeah. So we're recording now. So Dick, this is Business Talk. It's Business Talk After Hours because we release it at 6. It might someday become Business Talk Live or Business Talk Monthly. I don't know what it evolves into, but maybe you want to just tell us, especially since I don't know about you, your company, what you do, and
Sure.
so forth.
I'm with Beechwood Capital Advisors. We are an investment bank. We're registered with FINRA and supervised by the SEC. We raise capital and we do M&A advisory work. We are industry agnostic. We've closed deals, for example, in the last year in all sorts of industries. The linen supply business, we closed one with we're currently working on a steel company. We're working on a manufacturing sale. So we literally don't focus on any given industry. We do stay away from real estate and high-tech medical. Otherwise, our focus is the lower end of the middle market. We'll do 5-6 deals a year, and we tend to focus on more, I would say, service businesses, some manufacturing, and a lot of distribution.
Are there any kind of size deals that you guys focus mostly on, or your
Yeah,
raises?
the size deals are typically, the valuation is between 5 and 60 million.
Okay.
Typically, the starting point is we need EBITDA of $2 million and above. And when we're raising capital, it's typically we start at the $3 million level.
Okay, well, why don't we do this, since Mike and I think Trevor know you better. Why don't I let them get started with some questions for you, and we'll start the discussion, and I'll jump in when something occurs to me, because I'm sure it's going to be a lot.
Yeah, sounds great. Dick, thank you for joining us today. I just have one initial question, for you is, I know you guys have been very, very active, working on many, like, as you mentioned, multiple different industries. Tell me a little bit about the challenges you're finding with business owners that are exiting now, and how is that different than pre-pandemic, right? What are some of the challenges you're finding with these transactions, especially due to what's going on with the pandemic?
Biggest challenge we have right now is what's going to happen in the future. For example, we're involved in the sale of a steel company. They do erection steel as well as miscellaneous steel, which is stairways, railings, and that sort of thing. They have literally doubled their EBITDA this year. So the fundamental question everybody is having is this sustainable? Because a lot of their work is coming from the hospitals and the pharmaceutical industry.
Got it. They benefited from the pandemic.
Exactly.
Yeah.
They benefited from the pandemic. Another company we sold back in June of 2020 was a incontinence distribution company that basically continued to have its supply throughout the pandemic. So they basically did about 20% better during the pandemic than they did before. So, some of the businesses do very well, some of them don't. A linen supply business we sold, we really had to get creative in terms of structuring a payout on that because there was no immediate value given that all the restaurants were being shut down. So what we finally did, we took the structure and said, we'll pay the creditors over time, starting in March or April, when hopefully the vaccines are out and things settle down. So, it'll be a couple of months before we see how that works out.
Right. But it's really up to the buyer and the due diligence team to determine, right, what's downward pressure that may be short-term and temporary, and or maybe upward pressure on profits that may be short-term and temporary, and what's going to happen. But I guess nobody has a crystal ball. Even the president last night said, well, we'll probably be back to normal next December, but don't hold me to that, is basically what he said. So,
Exactly.
Right. Yeah.
Exactly.
So I guess it's really, when you look at it, it's the unknown on both sides. The business that's doing, double the EBITDA in the past year, is this sustainable? And on the flip side, the business that's non-existent or has dropped significantly, is this going to be the ongoing? Because obviously restaurants are eventually going to open back up and things are going to happen again, where their service is going to be needed. Maybe it's not as needed right now, but at some point in the future, who knows exactly when that will be, but there'll be more demand. And that's one of the things that we see. I mean, a lot of pent up demand, in a lot of these areas like hospitality, leisure, travel, a lot of things that people weren't able to do in the past year.
Right, but industries may
eventually,
contract though as a result of it. They may contract.
Well, there'll
Some of-
be exactly
yeah, be less
consolidation.
players.
Yeah, consolidation.
Like,
Absolutely. Well, yeah, go ahead, Dick. I'm sorry.
yeah, I just wanted to comment on that. That's a really good point because the linen supply company is now picking up a number of customers all over New Jersey and to some extent New York City because their competition has gone out of business.
Yeah.
Yep.
Their
So
benefit,
basically, not only did we rescue them, but we created a much better platform for them by combining them with a company in Pennsylvania. So they're in a much better position to be competitive now in the New Jersey and New York market.
Have you seen that industries where companies that used to be competitors may be combining because of the fact that they just don't have the staying power to do it on their own?
I think that's the case in the linen supply industry, big time. I think we're seeing it with restaurants. We're also seeing it to some extent with the in the incontinence business because the sale was to an Italian buyer who's a manufacturer of those products. They are running into a wall in Europe because the buyers are mainly healthcare systems within Europe, and it's very low margin business. So they're trying to get to the consumer in the U.S. directly. And that was a good start for them to get into the U.S. market.
What's incontinence devices like catheters and things like that?
Actually, no, pads and that sort of thing.
Ah, got it. Okay. Have you seen more deal flow during pandemic in general, or not necessarily?
I think we've seen less deal flow, but it's better quality. We're seeing fewer two guys in a garage with a dog who want to raise capital. We're seeing fewer of those deals and much more. We're looking at for example, a company right now on the East Coast that does equipment distribution, mainly industrial stuff to hospitals and manufacturers and that sort of thing. And it's a nice quality business. It's got a decent EBITDA, a good sales record. And basically the owners feel they're ready to get out. They want to retire at this point. And we're hearing that from a lot of people who are saying, look, I don't want to go through another cycle. It's great to sell now. There's a lot of money out there. The valuations are good.
They are good?
Pretty much so, yeah.
Oh, okay.
In fact, we're getting bids out there. The linen supply company turned out to be much higher than we expected. We also got a very good valuation on a lighting company. We sold out of bankruptcy. It was about double what anybody, actually close to 4 times what anybody expected they would get. And then even the linen supply company is probably going to come in at a much higher number than we anticipated at the beginning of the pandemic. So yeah, it's clearly coming back, and there's really so much money out there right now that people are willing to pay up to get deals done.
No, absolutely. I was just going to ask you that too. Really interesting. You say a lot of money out there. How aggressive have you seen private equity right now in buying? Because obviously they've had a lot of cash, and I would say more cash than deals that exist, even pre pandemic. How aggressive have you seen private equity kind of getting in and putting money to work in this environment?
I think they've been pretty aggressive. We're dealing with 2 private equity funds in the steel company. And I was really surprised. I thought they would come in because it's a contractual business and a construction business. They probably come in around 3 or 4 times, and then maybe some upside if the company does well. But they're in there for 5.5 times. We'll see if the business ultimately gets closed. But the sense I've gotten is people want to get deals done, and also you've got they lost the good part of a year in 2020. So a lot of these funds are getting to end of life, and they want to get the money out there for obvious reasons.
Makes sense. Makes sense.
I actually have a question.
Now-
It's a good point where you put the 5.5 multiple. So are you seeing like a fundamental change now inside the pandemic, right? Like I'll call it pre-post with valuations, where like an average 3 to 4 multiples now maybe trading at a 5 to 6 just due to scarcity or more strengthening on the valuation?
I would say it's more on the anecdotal side. I
Okay.
haven't seen actual numbers come out at this point. But for example, the incontinence business, the Italians originally came in and spent almost an afternoon telling us it was a ship business. They, excuse my French here. I hope this doesn't, hope you can edit that out. But
No, this is after hours. We can say whatever we want. So
got it. Okay. So the point being that they gave us a really hard time about the business and said, look, you ought to just give this business away because it's worth no value whatsoever. They came back a week later with a bid literally 4 times higher than anybody else bid. So it's, what people tell you and what they ultimately do, there seems to be a complete disconnect. The other thing we're finding a lot of in the middle market is the bid ask is very, very wide in these businesses. For example, we were involved in the sale of a sensor and switch manufacturing business. The bid ask for that business with 3.5 in EBITDA was roughly the low was 9, the high was 18. And we're seeing this in a lot of businesses. So,
Wow. Now, with the consolidation part of it, where you have businesses that may not last through this and they're bought up and what have you, do you see more of that happening in bankruptcy court, or do you see that more happening prior to getting to that stage? Because you mentioned the linen company, right? So linen company basically buying up a lot of these other businesses. Are they waiting till the point where they're basically going bankrupt, or are you seeing more of the buying happening prior to that stage?
seeing more of it happening prior to that stage. Because with the PPP money, there's very little going on in the bankruptcy sector now. We talk to those guys on a regular basis. And in fact, the lawyers are literally starving right now because
I have a lot of friends who do bankruptcy law, and you're probably talking good 8 to 10 months or a year before you see any of that stuff coming around. Yeah,
exactly. So, I think bankruptcy is going to continue to be slow, and the PPP money has helped extend the life of a lot of these companies. But I think as we start getting back to normal, some of them are going to go through bankruptcy, and some are going to sell out to competitors.
I would think there's a huge opportunity in certain industries to consolidate. I was talking to a friend of mine who owns a dry cleaner, and that is a bifurcated industry. They're really just mom and pops. There's no real large player.
Yep.
And what do you do? I mean, if you're looking to expand your streams of income, right, for a corporation that's expanding into other, what do you expect? What do you clean Uggs now instead of suits? I mean, I guess, I don't know. I always felt that was a big industry for consolidation at some point.
Well,
we'll always need dry cleaning. It's just a question of what we need it for.
I'm not sending my polo shirts into dry clean, that's for sure.
Well, I go to my dry cleaner and the place is half empty, and his hours are different now, and nobody's bringing suits
They
in.
could find a way to automate some of that machinery they have in house to some respect, to use it in some way, shape, or form. If someone would come up with a great business idea, that'd be amazing.
But that's an investment for a guy who's probably living hand to mouth on a. I mean, I'm in my underwear right now, so I'm only taking my shirt in to the dry cleaner, right? So, what? I don't take pants in or anything anymore. So, I probably go once a month. I used to go every week, and I'm sure a lot of people are like that. So I don't know. We'll have to see what happens. But those are the things that on the street, because I'm a business attorney, that I see with local businesses.
Right.
Restaurants is the same way. There's the smaller ones are not going to survive. They're partnering up for different things, using each other's facilities. And I have a coffee shop, but you're closed in the mornings, and I'm not at the train station anymore because nobody's going there, so I can open up and stuff like that. So I think, but it's interesting to hear that there's still a lot of on the private equity side, there's a lot of money out there and a lot of deals that are still happening. And I always thought there would be like downward pressure on price and it would be more of a buyer's market, but it doesn't. It seems to like fly in the face of what I thought would be logical.
Exactly.
It surprised me as well because I thought 2020 was going to be a disaster for us, and we closed 4 deals during 2020, and the pipeline is full at this point. Also, other investment bankers we're talking to are doing extremely well and looking to hire right now. So
yeah,
it's
because you had mentioned before, some people are retiring, maybe exiting the businesses earlier. If you had a 5 to 7 year plan, let's say you're going to exit the business because you're getting up there in years, this all happens and you're like, I don't want to deal with this Zoom and all the technology I got to do. I'm
right.
going to accelerate my process. So, but that you would think would put downward pressure on price. Doesn't seem to do it.
It doesn't seem to be doing it, and I just think it's a function of how much money is actually out there.
Yeah, that's the problem. There's too much dollars chasing too few opportunities. Well, it's good for the sellers, and we're just pumping money back in the economy anyway. So
Exactly.
I have an interesting question, Dick, because I know that you only have limited time with us today, but maybe just kind of scoping the process, right? So I am a $25 million business. I have X, Y, and Z EBITDA. I'm looking for growth via strategic M&A, or I'm looking to sell. Like I'm unfamiliar with the process as much as I like to say I am, but from, an expert like you, I'd love to hear how that starts. Just kind of high level overview.
Well, it normally starts by going to the wealth manager or the guy's lawyer and saying, what do I need to retire? And he gets a number, and then they back into, is the business actually worth that based on EBITDA and everything else? Then they typically end up with us with, we want to sell the business. So we'll sign an engagement letter. Essentially, we'll take anywhere between 2 weeks and a month, put together investment banking quality materials, a teaser, a sim, for lack of a better word, and build a virtual data room. We'll send out the teaser, which is usually does not mention the name of the company. We'll attach an NDA to it, which is typically signed blind. And if people are interested, they'll sign the NDA, they'll receive the SIM, and we'll open up the data room to them. We'll give them 3 or 4 weeks, ask them to come back and give us an indication of interest, which is basically, we love Joe, we love his business, and we think it's worth between X and Y. Once we get a number of those, we'll have management meetings, Zooms in this case, and then turn around and give them 3 weeks to do additional due diligence, make requests on their accountants and whatever, and then require an LOI. And once the LOI comes in, they then make a decision, who do I want to work with going forward? And 60 to 90 days, final due diligence is done and the deal is closed. It's usually maybe a 6 to 9 month process.
yeah, that makes sense. That makes sense. I'm working on some deals now. They're like, can we close this month? You just signed the contract like 8 days ago. Hey, close this month. You need like an RAO from an LSRP. You don't even know what an LSRP is. Yeah. So
I've actually heard quite a bit of things, Dick, in the fear about the failure getting LOI signed. Have you kind of seen that at all with, not only on maybe I'll call it the financial health of the business, but just in general, those kind of not making its way all the way through?
Yeah, at the lower end of the middle market, maybe 50% close. And a lot of that is because either the seller is not really ready and they'll sell again in 2 or 3 years. Or what happens a lot of times, they haven't taken into consideration what the stakeholders want, such as, I'm concerned about my my daughter-in-law. She has a place in the business. She may want to buy it. I'll put this on hold until I figure that out. So 50% is probably a pretty good number.
And I guess, yeah, no. And I would say too, on that point as well, is that if you have different types of partnerships where, one has one goal and the other has another, right? Where, one basically is ready to retire and move on to the next phase of their life, whereas one might be still in growth mode. I want to continue on this path, where it's kind of an interesting dynamic, I guess, when you talk about, you know, who the buyer is and how that looks like after post close.
Exactly.
Dick, I know we're running out of time, but do you guys do a lot of work? I find when you're dealing with small businesses, let's say in the 25 million and under gross revenue, you know, they're doing a little bit of EBITDA, whatever, and they want to sell their business. Usually the way they haven't been operating their business for sale. They've been operating their business to support their lifestyle, to support their family lifestyle. They're taking a lot of money out of the business.
Right.
They're, you know, it may not be their whole org chart may not be that clear. Trevor and I were looking at a deal a while ago, and it was a mess. The guy was 92 and he owned the company and he ran it to take care of his family. And they're trying to show us all these things you got to add back in because the guy was taking it out, and the math, it was like magic math. So do you find a lot of times you're working with the companies to kind of get them ready, say, hey, listen, you're not ready to go to market. You got to clean up this and clean up that in order to get a decent price?
We don't typically do that. I would bring in somebody like Trevor, who kind of focuses on this stuff because, you know, a lot of times they simply want to go to market and the valuation that they really need to retire isn't there. So we'll tell them, look, for every $100,000 of EBITDA you find or you can demonstrate is real, that's $500,000 off in your pocket. So you know, sometimes you can create a case that you can do all the add backs, which is why we typically hire an accounting firm to do a Q of E.
Right.
You know, which basically comes in and that gives credibility to numbers.
Got it. All right. Well, I know your time's short and you got to jump for an 11 o'clock, but I appreciate you coming on, Mike and Trevor. Always a pleasure. And hopefully we can do this again real soon.
Would love to do it again. And thanks for inviting me, guys. Really appreciate it.
Appreciate it, Dick.
Thank you for joining.
Thanks. Appreciate it,
Absolutely.
Dick.
You guys take care. Have a good one.
You too.